We are embracing a new topic today, stockholders' equity. Now, some of the items that we're going to cover in these lectures involve identifying the benefits and the disadvantages of the corporate form of ownership. We'll talk about issuing common stock, and we'll talk about the difference between preferred stock with common stock and bonds payable. We'll account for treasury stock. We'll talk about retained earnings and the ability to record cash dividends. We'll talk about stock dividends and stock splits and how they affect the financial statements. We'll prepare and analyze the stockholders' equity section of the balance sheet and the statement of stockholders' equity. And then lastly, we'll evaluate company performance using information on the stockholders' equity section. So we've got a lot to cover today. So first of all, we're going to talk about the sections on the stockholders' equity. Now, we know in some of the previous lectures, we put our energy focusing on assets, different types of assets. And then we focused on liabilities. Now, in this lecture, we're going to talk about the third component of the accounting equation, which is the stockholders' equity section. Now, we use the term stockholders' equity opposed to owner's equity because we're focusing on corporations here. And the stockholders are the owners of the corporation. Equity is equal to what we own, those assets, minus what we owe, liabilities. The difference is stockholders' equity. Now, stockholders' equity consists primarily of three classifications: paid-in capital, retained earnings, and something we're going to call treasury stock. Paid-in capital is the amount of stockholders' equity. So paid-in capital is the amount that the stockholders have invested in the company, while retained earnings is the amount of earnings the corporation has kept or retained, which means the earnings that haven't been paid out as dividends. And then treasury stock is the corporation's own stock that it has reacquired. Now, this illustration here shows the stockholders' equity section of American Eagle's balance sheet. At this point, take a note that the stockholders' equity for American Eagle consists of total paid-in capital, it consists of retained earnings, and treasury stock. Stockholders' equity is increased by paid-in capital and retained earnings, but it's reduced by treasury stock. Now, in this section, we are going to discuss transactions that involve paid-in capital. A better description for paid-in capital might be invested capital, since it's the amount stockholders invest when they purchase company stock. Invested capital is the amount of money paid in to a company by its owners. So to better help understand the composition of invested capital, it's helpful to know more about different types of corporate ownership. So we're going to identify first the advantages and disadvantages of the corporate form of ownership. This slide here represents what we call an organization chart, tracing the lines of authority for a typical corporation. Now, ultimately, a corporation's stockholders control the company because they own the company. But by voting their shares, the stockholders determine the makeup of the board of directors, and the board of directors, in turn, appoint the management to run the company. Most corporations that end up selling stock on a major stock exchange don't always begin that way. Usually there's a progression of equity financing stages, ultimately leading to a public offering. So as you see here, they first raise money from founders of the business, their family and friends, and then to grow they get angel investors. Sometimes they go with venture capitalist firms that help provide additional funding. And then from there they might start their initial public offering. There is a client I have right now who has a brewery, and they're at the stage where they initially came in and got money from business, from friends and family. Now they are, and they've already done the angel investors. Now they're going to venture capital firms in order to expand into other states and territories. Now, as summarized in this slide, most corporations first raise money by selling stock to the founders of the business and to their friends and family. As the equity financing needs of the corporation grow, companies prepare a business plan and seek outside investment from angel investors and venture capital firms. Now, angel investors are wealthy individuals in the business community, like those featured on that show Shark Tank, that are willing to risk investment funds on potentially promising business ventures. Individuals and angel investors may invest from a few $1,000s to millions of dollars in a corporation. Venture capital firms provide additional financing, often in the millions, for a percentage of ownership in the company. Many venture capital firms look to invest in promising companies to which they can add value through business contacts, potentially financial expertise, or marketing channels. Most corporations do not consider issuing stock to the general public, which is like going public, until their equity financing needs exceed $20 million. Now, the first time a corporation issues stock to the public, it is called an initial public offering. We call it an IPO. Now, corporations can be either public or they can be private. Now, the stock of a publicly held corporation trades on the New York Stock Exchange or the NASDAQ, the National Association of Securities Dealers Automated Quotations. We don't hear that as much as we hear the NASDAQ, or over-the-counter trading, OTC. All publicly held corporations are regulated by the SEC, the Securities Exchange Commission, resulting in significant additional reporting and filing requirements, which also then adds to much additional cost. Now, a privately held corporation doesn't allow investment from the general public and normally has fewer stockholders than a public corporation would. Generally, corporations whose stock is privately held do not need to file financial statements with the SEC. Whether public or private, stockholders are the owners of the corporation and have certain rights. They have the right to vote, including electing the board of directors. They have the right to receive dividends and the right to share in the distributions of assets if the company is dissolved. This slide explains these stockholders' rights. Now, this slide summarizes the advantages and disadvantages of a corporation compared to a sole proprietorship or a partnership. Now, the biggest advantage for a corporation is called limited liability. Limited liability guarantees that stockholders in a corporation can lose no more than the amount they invested in the company, even in the event of bankruptcy. In contrast, though, owners in a sole proprietorship or partnership can be held personally liable for debts the company's incurred above and beyond any investments they've made. Another benefit is the ability to raise capital and to be able to transfer ownership in a corporation. So because corporations sell ownership interest in the form of shares of stock, to be able to transfer ownership is pretty easy. An investor can sell his or her ownership interest via shares of stock at any time and without affecting the structure of the corporation itself or affect its operations. So as a result, attracting outside investments easier for a corporation than it is for a sole proprietorship or a partnership. Now, there are some disadvantages. There's taxes. Owners of sole proprietorships and partnerships get taxed once when they include their share of earnings in their personal income tax returns. But for a corporation, they have something called double taxation. So as a legal entity separate from its owners, a corporation pays income taxes on its earnings, and then when it distributes the earnings to the stockholders in the form of dividends, then the stockholders, which are the company's owners, have to pay taxes a second time on the corporate dividends they received. So in other words, the corporate income is taxed once on earnings at the corporate level, and then it gets taxed again when those earnings are distributed in the form of dividends to the shareholders. A key point to know: the primary advantage of corporate forms of business are limited liability and the ability to raise capital. The disadvantages are additional taxes, calling it double taxation, and lots of paperwork. Here's a question for you. Which of the following is a primary advantage of forming a corporation? A, reduced taxes. B, increased personal liability of the owners. C, increased ability to raise capital and transfer ownership. Or D, fewer state and federal reporting requirements. I hope you got that. C, the ability to raise capital and transfer ownership with ease. Now let's talk about issuing common stock. We can think of the common stockholders as the true owners of a business. The number of shares of common stock in a corporation are described as being authorized, issued, and outstanding. Now, this slide summarizes the differences between these various terms. Authorized stock is the total number of shares available to sell that is stated in the company's articles of incorporation when they begin a corporation. The authorization of stock is not recorded in the accounting records. However, the corporation is required to disclose in the financial statements the number of shares that they are allowed to authorize. Issued stock is the number of shares that have been sold to investors. A company usually does not issue all of its authorized stock. And then outstanding stock is the number of shares held by investors. Now, issued and outstanding shares are the same as long they're the same amount of shares as long as the corporation hasn't repurchased any of its own shares. Treasury stock refers to those shares that have been repurchased by the company. they're included as part of shares issued, but they're excluded from shares outstanding. Let's take a moment and look at the different types of stock, because we're going to focus on this later. So we've got authorized, that available to sell, which is documented or noted in the Articles of Incorporation. Issued are those that are actually sold, which does include the treasury stock that the company's purchased back. And outstanding are those held by investors that exclude treasury stock. Make sure you are familiar with this. Now, par value is the legal capital per share of stock that's assigned when the corporation is first established. Par value originally indicates the real value of the company's shares of stock. Today, par value has absolutely no relationship at all between the market value of the common stock. Laws in most states permit corporations to issue something called no par stock. No par value stock is the common stock that has not been assigned a par value. Most new corporations, and even some established, such as Nike and Procter & Gamble, issue no par value common stock. In some cases, a corporation assigns a stated value to the shares, and those that put a stated value on those shares, that stated value is treated and recorded in the same manner as par value shares. Now remember, a common mistake, people can confuse par value with market value. No. Par value is just the legal capital per share that gets set on that stock when the corporation is first established. And it has no relationship to real value. Market share is the value per share, which is ultimately equal to the current share price. In many cases, the market value per share will far exceed the par value on the stock. Now, when a company receives cash from issuing common stock, it debits cash. If it issues no par value stock, the corporation credits the equity account called common stock. So, for example, in this first journal entry, let's assume Canadian Falcon, a specialty retailer of casual apparel and accessories, issues 1,000 shares of no par common stock at $30 a share. We record the transaction as shown here, with a debit to cash for $30,000 and a credit to common stock for $30,000. Now, what if the company issues par value stock rather than no par value stock? We are going to now credit two accounts. We credit the common stock account for the number of shares issued times the par value per share, and we credit an additional paid-in capital for the portion of the cash proceeds above par value. So, for example, assume that Canadian Falcon issues 1,000 shares of 1 cent par value common stock at $30 a share. As shown in this journal entry, the company would credit the common stock account for the par value. 1,000 shares times 1 cent per share gives us $10. The company credits additional paid-in capital for the portion of the cash proceeds that are above par value. Let's check a question here. Company A issues 20,000 shares of $5 par common stock at $12.50 per share. The entry to record the issuance would include which of the following? A debit to cash of $100,000, B, a credit to common stock of $250,000, C, a credit to additional paid-in capital of $150,000, or D, a credit to additional paid-in capital of $250,000. So the company is going to debit cash for $250,000, which is 20,000 shares at $12.50 a share. It's going to credit common stock for the par value. The par value is $5, so it's going to credit common stock for 20,000 shares times $5. And then the remaining, it's going to credit to additional paid-in capital for the difference. Now we're going to contrast the difference between preferred stock with common stock and bonds payable. Now preferred stock actually has a mixture of attributes somewhere between common stock and bonds. Now common stock is equity, bonds are liabilities. This slide provides a comparison of common stock, preferred stock, and bonds along several dimensions. Note that preferred stock falls in the middle between common stock and bonds for each of these factors. So as you see here, voting rights, common stock is part of equity. They're owners of a company. They have the right to vote. Bonds are just debt, liability. There's no voting rights. They don't own the company. Preferred stock is in the middle. Generally speaking, preferred stock does not have voting rights. Risk to the investor? Of course, the common stock is the highest. You can lose it all. Bonds have the lowest risk, and preferred stock is in the middle. Expected return to the investor? Common stock has the highest return. Bonds are just going to get paid the interest rate, and preferred stock is in the middle also. As you see here, preference for dividends and interest. Common stock, not so well. Distribution of assets, common stock, not so well. Where the bonds must get paid their interest. Preferred stock is in the middle, and we'll talk about why. And then tax deductibility. The benefit of issuing debt is you can deduct the interest. Common stock, you cannot deduct dividends. So that's a negative in having equity for financing purposes. Now, preferred stock is especially interesting due to the flexibility allowed in its contractual provisions. So, for instance, preferred stock could be what we call convertible, redeemable, or cumulative. Preferred stock may be convertible, which allows the stockholder to exchange shares of preferred stock for common stock at a specific conversion ratio. Occasionally, preferred stock is redeemable at the option of either stockholders or the corporation. And a redemption privilege allows preferred stockholders that option under specified conditions to return their shares for a predetermined redemption price. Similarly, shares may be redeemable at the option of the issuing corporation. Now, assume that a company issues 1,000 shares of 8% $30 par value preferred stock and 1,000 shares of $1 par value common stock at the beginning of 2016. If the preferred stock is cumulative, the company owes a dividend on the preferred stock of $2,400 each year, which would be 1,000 shares at 8% at $30 par value. If the dividend is not paid in 2016 or in 2017, dividend in arrears for the 2 years will total $4,800. Let's say the company declares a total dividend of $10,000 in 2018. How will the total dividend of $10,000 be allocated between preferred stockholders and common stockholders? Well, it depends on whether the preferred stock is cumulative or non-cumulative, as shown in this slide. Before it can pay dividends to common stockholders, if the preferred stock is cumulative, the company must pay the $4,800 in unpaid dividends for 2016 and 2017, and then the current dividend on preferred stock of $2,400 in 2018. After paying the preferred stock dividends, the company can pay the remaining balance of $2,800, which is that $10,000 minus the $4,800 and the $2,400 in dividends on the common stock. So this slide displays the stockholders' equity section of the balance sheet for Canadian Falcon following the issuance of both common and preferred stock. A key point, preferred stock has features of both common stock and bonds and is usually included in the stockholders' equity section. However, some preferred stock mandatorily redeemable is so similar to bonds that we would include it with bonds payable in the liability section of the balance sheet. Let's look at a problem. Exercise 10.4 in your book. Nathan's Athletic Apparel has 2,000 shares of 5%, $100 par value preferred stock the company issued at the beginning of 2017. All remaining shares are common stock. The company was not able to pay dividends in 2017, but plans to pay dividends of $22,000 in 2018. Based on assuming the preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders in 2018. And then the next is assuming the preferred stock is non-cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders in 2018. So the preferred dividends in arrears for 2017 is $10,000, which is the 2,000 shares at 5% times $100 par value. The preferred dividends in arrears for 2018 is the same. So based on the $22,000 available for dividends, if it is cumulative stock, they would be required to pay the $10,000 for 2017, the $10,000 for 2018, and then the remaining that's left, the $2,000 left, would then go to the common stockholders. Now, if it is non-cumulative, it's a little different story. We don't have to worry about the dividend in arrears. There's zero for 2017. In 2018, it would be the 2,000 shares at 5% times $100 par value, the $10,000. Then the remaining, or the $12,000 of the $22,000, would get to go to the common stockholders. Which of the following is a primary advantage of owning preferred stock? A, preferential voting rights. B, deductibility of tax deductibility of payments. Preference over common stockholders in the distribution of assets in the event of dissolution. Or D, higher risk to investors. Remember, it's a combination of debt and equity, so it would be C. In case a company is dissolved, the preferred stockholders would have preference over the common stockholders in the assets of a company.